welcome to another episode of Kuvera Insights, where we talk to industry leaders and learn more about how we should be managing our wealth. Today, we have the pleasure of inviting Chintan. Chintan Haria, he's the head of product development and strategy at ICICI Prudential Asset Management Company, one of the largest AMCs. Thanks, Chintan, for joining us. Just a quick introduction for Chintan. He's been with ICICI Pru Asset Management as a management trainee, and then he has worked across multiple different sectors, multiple different funds, has been an industry veteran for a very long time, has seen the industry evolve, has seen all the developments that have happened that have made ICICI Prudential the big name that it is today. So his background, he has a master's in commerce from Sydenham College of Commerce and Economics in 2005, and he's a fellow member of the Chartered Accountant from Institute of Chartered Accountants of India. So welcome, Chintan. Pleasure to have you here.
Thank you so much. And while you did mention good words like veteran and has so much experience, I still feel that it is just the first day I'm learning because the market doesn't cease to stop. I mean, I think I've learned more in the last 1 year than I did in the last 16 years, and probably it's just still the start of the learning journey. So thank you for.
But that's always going to be true, right? It's the market is the ultimate teacher. So I think, but it's still pretty impressive, right? 16 years is a long time, and I think the cycles you have seen, I think everyone can definitely learn a lot from that experience. So starting out from there, right? I mean, you've been, like you said, 16 years. Last year has been the biggest learning year. What was so different last year, and where do you believe the market is right now?
Yeah, so I think if I sum up the 16 years, and I saw the Lehman crisis, which was the US housing crisis, and that was a financial crisis, the largest financial crisis that I have seen, and that there was a response to that in terms of central banks putting in more money. And then we felt that, okay, when is the next financial crisis happen? When is the next financial crisis happen? And then the final crash actually happened in March 2020 because of a health pandemic, which obviously for the last 100 years, humankind had not seen. And so it was a big learning that a potential pandemic, never read about it, never seen about it. And so you can say that probably I missed out on reading enough, and that's the learning. But the response to the health pandemic was also the same, right? Liquidity steroid. And how that liquidity steroid then panned out in the next 12 months, and how we reached an all-time high across all markets, with equities, commodities, agri-commodities. And more importantly, what it means for the next 3 years and what it means for investors is something which has been a good learning so far. Luckily for us, we were constructive because our valuation models did tell us in March 2020 that it is flashing green in terms of markets being too cheap. Currently, of course, that's probably not the case. We are not very cheap, but let's see what the next thing.
Where in that risk-reward spectrum would you put the markets today in comparison of history? I know you guys published this, that green-red. So if you can just, talk a little bit more about that, that would help.
Yeah. So in terms of, if we see past valuations and or other valuations based on past historical averages, currently the markets are not cheap. No two ways about it. But we have to see it in the context of what's happening globally in terms of valuation re-ratings that are happening. So past averages mean little when the entire tectonic plate is shifting upwards globally. Will it stay there or not will depend on whether liquidity will stay or not, and that's where we have to answer that question. But let's look at India from a market cap to GDP perspective. We are 100%. From a valuation perspective, because last year was such a difficult year in earnings, we are at about 31.5 times past earnings. But the good news is that with normalization of earnings, and more importantly, metals and energy starting to participate along with the banking sector in terms of profitability, on a forward basis, it looks like, based on earnings estimates, that we would be probably in the range of 22 times FY22 and 18.5 times FY23, if I'm not mistaken. So obviously these numbers are subject to change based on assumptions that profitability is going to improve. But long-term average for India has been 16, 17 or 16 odd. We've been at 18 around. So we're not too expensive. Let's look at the numbers in US. In US, the market cap to GDP is 220% today, relative to 120% even in the peak during the Lehman crisis. And US, unlike in India, the business cycle is advanced. They've seen tax cuts, they've seen business growth, they've seen earnings growth, etc., all happening in the past. The dollar strengthening is behind us. So for an economy which is growing at maybe 5% at best in US, the market cap to GDP at 220% may not be sustainable. While in India at 100% market cap to GDP with an economy which can potentially grow at 8% real GDP and maybe 6-7% inflation, which is about 15% nominal GDP, this 100% number looks more sustainable. So with that, along with the fact that corporate profitability as a percentage of GDP, which was 8% in 2008 in India, has come down to 2%, we are also at a low. So business cycle wise, we are at a low, and hence, while our valuation parameters for compared to last 10 years or 15 years average show us that we should be lower in equity, if next 2 years pan out the way we are expecting, then maybe still Indian equities have steam if you are in the right sector, in the right manner, and in the right product.
So if I can, to put it in a more or in a slightly different terms, so will it be fair to say that while prices have run away a little bit, the belief is that as the pandemic comes out, earnings will catch up. So the price to earnings ratio, which currently looks a little bit inflated on a trailing 12 month, but because that trailing 12 month is mostly that pandemic time period, should revert down to like what you were saying, the forward 22 or 23 PE of 22 or 23, right? So that actually makes a lot of sense. So in a way, then the risk comes in whether the earnings rebound will happen or not.
True.
Is that a fair statement?
True. And as things stand right now, it seems comfortable that earnings rebound will happen.
Is happening, yeah. At least the early numbers are really good. Like the companies that are coming out with that, I've been following them, and all of them are, and actually the management is quite bullish, which is usually a very good sign. Yeah. So in this scenario, right, and you also had product development for ICICI. So what kind of products are you're the most proud of kind of launching in the Indian ecosystem, and what kind of products do you think an investor can see going forward?
Yeah, so I think the bouquet of products which we have created, I think the idea is that we should be a one-stop solution for investors, all investment needs, and in very sensible, well-defined manner as to what that product would want to achieve for the investor. And within that, of course, the product which we are most proud of is the dynamic asset allocation category or the balance advantage fund, which we firmly believe should be a part of every investor's portfolio. Simply because
just quickly, if you can explain what a dynamic asset allocation, just for some of the viewers who may not know, that would help. Yeah.
Which is exactly what my next statement was going to be.
Okay, sorry.
And, which is a very simple category where the idiom of buying low, selling high, increase equity when the markets are low, decrease equity when the markets are high. You keep on doing it basis valuation models for days and days and years, and ultimately at the end of the cycle, you end up making the wealth creation while protecting the downside.
Quick question here, right? Compared to last year and looking at today, what was the equity allocation in a dynamic asset allocation fund then, and what is it now? Because that would probably be a very clear indication of.
You're almost reading my next statement. And
okay.
To be honest. So which was my next point, that essentially, if we see what has happened in the last 15-18 months, how many of us were actually able to increase equity exposure in the February and March fall? Because even if I look at myself, I found the pandemic so overwhelming that I was frozen. I was scared about losing money because markets suddenly fell, and we don't know when they will bounce back. And when valuations became cheap, everything was looking so cheap. Still increasing equity exposure.
So your friends and family are suffering. The news flow is really bad, not in the sense of people losing money, but people losing lives, right? It's very hard to react. I totally hear you.
Yeah, so
it's a very hard situation.
Just to put this in numbers, how the dynamic asset allocation fund helps you, and if you're invested in it, how it basically helps you without having to worry about, this aspect of not being able to put money, not being able to, get the courage to invest more when the market falls. In January 2020, markets then were probably doing very well just before the fall. The fund was about 47-48% invested in equities, therein and thereabout. Then there was a sharp fall in February, where 6% market fell, and I think in March we fell another 25% roughly. In this February and March fall, we went from 47-48% to 77% in equity. That's about 30% incremental equity invested in in the 2-month period in the balance sheet.
And this was automatic. Nothing was asked for the investor. The fund did that internally on its own.
Correct. So that's the basic model, right? Whenever the markets kept on going up, we kept on booking profits and sitting on arbitrage plus cash, so that whenever the markets do fall, we don't have to go to the investor. We will invest that money nevertheless, and which we did, and we follow the model with discipline. The important aspect is it is the model which is telling us, the dynamic price to book model which we have, and we've been running it for the last, I think now almost 14 years. The model tells us, last 12 to 13 years, the model tells us that how much equity should be there basis the market valuations today. And it told us that you should be around 75, 78%. And we basically went there. The fund manager or the team did not think, oh, we should be lower. It's very easy to think, but we keep the emotions intact and follow the objective of the model. And similar to that, since the last 1.5 or about 15 months, from March 2020 to June 2021, as the markets have kept on going up, we've kept on booking profits. And I think we are close to about the 40% equity level today.
So we were in January 2020, but you took the fall and the
yeah. So effectively, again, the profit booking has happened. So as an investor, you got the benefit of investing in the market fall. You got the benefit of reducing equity as the markets go up. You didn't have to follow the market. You didn't have to keep on, seeing. And more importantly, when the markets fall, it becomes difficult to decide where to take out the money from, because it's not necessarily you keep the money in a bank account.
True.
So I think
and Chintan has missed out one of the other really amazing feature of this product that I personally love a lot, is that all of this rebalancing happened tax free. It might seem like that's a salient feature, but that's 10% or 15% of short-term capital gains or long-term capital gains saved right there. And I mean, I love this fact. Wherever you can rebalance in a tax-free way without paying taxes, that's definitely a win-win. So fantastic. And so what else? What's next, right? What's next in the product journey for you?
So as we spoke,
where should investors be thinking about? So you have balance advantage fund, so that becomes kind of like a core fund, I would think, that people should think about. What else should someone be looking at?
Correct. So as I spoke earlier, that with inflation probably coming back in a big way, because investors have got more money in their hands and people have got more money in their hands and they are consuming. Just by way of an example, if we say in US, the loss of income of the lower income group was estimated in the last 12 months to be $500 billion. Versus that, the American government, through the Federal Reserve, has probably given more than $1.5 trillion of money in the hands of those people who lost for about $500 billion. So 3 times the money was given to those people who are in that group, which actually will end up consuming, and they do spend because they are basically struggling to make their ends meet. And suddenly, if you get that money, you really want to spend on basic needs which a human being has, which pushes the prices of commodities in general, and uplifts the entire price mechanism. It's happening in India as well. And whenever that inflation comes back, it basically leads to a diversified set of sectors doing well, right? Today, if we see the sectors like telecom and power, without which our discussion wouldn't have been possible, are cheap in India relatively and are doing well. And much like that, banking, many of the other sectors, India is an ocean in terms of the opportunity. And if you want to participate in that ocean of opportunity, we believe that investing in fully invested funds, which can participate across the market cap cycle, large cap, mid cap, small cap, across all sectors, will be good. And that's where we believe the Flexicap fund is something which should be looked at from a long-term allocation perspective in the fully invested equity category.
Fair enough. There's just only one thing I'll add. I think Chintan really stated very nicely how there is a bottoms-up pressure where people have just lost $500 billion, but they got 3x of that more. The other thing that has also happened is if you look at the affluent investors, right, there is a savings glut. You're not commuting to work. You're not spending outside. A lot of the discretionary spend, a lot of that spend has gone down to zero. You're not traveling. All of that budgets have gone down to zero. So people have more savings, and a lot of those savings are being channelized into financial assets, which is also kind of creating a price pressure on just valuation from a valuation perspective, right? So, 100% agree. In terms of investing across the market capitalization, so there's Flexicap, there is Multicap. So if you can throw some light on what are the similarities, what are the differences, what are the advantages of both of them?
Yeah, so I think over the last 2 years or so, there's been clearly defined limits for various categories in mutual fund. We know large caps have to invest minimum 80% in the top 100 companies. Mid cap, small cap have to invest minimum 65% in the mid cap and small cap respectively. And then there are other categories as well. Multicap and Flexicap, while people may feel it's the same, the difference is that in multicap, at all points of time, true to the name multicap, the fund house or the fund manager has to maintain minimum 25% in mid cap, large cap, and small cap, or large cap, mid cap, and small cap. So that's 25% in each. So at all points of time, if I have to club, minimum allocation to mid and small cap in a multi-cap fund will be 50%, right? So in terms of risk reward curve, if I have to say, multi-cap is slightly aggressive because it has minimum 50% at all points of time in mid cap and small cap. And if
it also takes away the discretion of the fund manager on which market cap
correct.
you want to be, because you're almost like your limits are being set. So the only discretion you have is in that 25% in some sense.
Correct. So it essentially becomes a decision on allocation based or stock picking rather than allocation between the various market caps. And then if you're able to pick the right stocks, then yes, multi-cap funds also have a certain audience which may want to have participation in large, mid, and small in that proportion. However, the Flexicap fund, which is a category which was created along with after the multi-cap fund rules were changed, it is a most unconstrained fund. It is the largest category in India today, and our belief is that as a category, it will keep growing because it is an unconstrained fund. There are no restrictions on large, mid, and small. Like you mentioned, there is a flexibility which the fund manager will have, and also among the sectors and stocks if they are picked well. So unconstrained and full flexibility would make probably Flexicap funds, if managed well and in the right manner, keep growing because they can participate across the segments and make money. And years like 2018, 19, 20 will be rare, where it's only the top 10 names which contribute to the markets while the rest of the market is probably in a very bad shape. That is rare, and we are coming out of that trough. So over the next 2 years, so we believe that Flexicap funds do present a good opportunity, and it is already the largest category in the market.
So two quick questions, right? Flexicap can go, so it can also go into the micro cap space.
Yes.
There's absolutely zero restriction, right? Like, okay. So is it fair to say that from a fund manager's perspective, this is the true unconstrained alpha representation of what the best fund managers and analysts believe to be the right opportunities? Because there are literally no constraints there, right? I mean, every other category you have constraints. This is like an unconstrained environment. So this should be like where all your top ideas or wherever you have the highest conviction should be in Flexicap. Is that a fair statement to say?
Absolutely, and that explains why obviously this is a category which is the largest category. It's basically.
So what kind of risks also does it create? So let's talk about the other part of it. Like, when an investor is thinking about investing in a Flexicap fund or a multi-cap fund or a fund that invests across market caps, what are some of the risks also that they should be aware of?
So the risk, of course, the primary risk is of it being a fully invested equity fund. So the risks of an equity fund lie, and that's where if you have a longer term horizon, that risk is more or less mitigated.
Right.
The other risk is if the fund manager obviously does not take the advantage of the flexibility and remains, let's say, in large cap and doesn't participate in mid and small cap. That can be one kind of risk, or the opposite of that, remains in mid and small cap and then probably does well when they do well, but then gets hurt. So lack of flexibility in the Flexicap fund is one of the biggest risks, and that's where if you can objectively manage that risk by having a method of being in large cap, mid cap, small cap, that risk gets mitigated.
Fair enough. So what kind of, from an investor perspective, what kind of at least risk attributes they should be looking at? Because, sometimes a lot of this alpha might take time to manifest, right? I mean, I would find it very hard as a fund manager, or I would find it to be a very high expectation to expect a fund manager to outperform year after year after year. And we also know from history that doesn't happen. So how should, because the one of the fears that's always there is that, it's a good category, it has certain very attractive features, but then people always fall victim to short-term returns. What happened in the last 1 year? So how do you kind of tell someone to kind of think about the bigger picture and stick with the fund?
True. So there the core aspect of the fund philosophy and strategy of the fund manager, the style of the fund manager becomes a very important decision-making tool. Let's say in the last 5-6 years, we've seen some flexicap funds doing exceedingly well because they were in large cap quality names, while those who were in value and cyclical names got hurt very badly in 2018, 19, 20. Were both of them wrong or right? The answer is not wrong or right. The answer is both have a particular style, and that style will work in different market conditions. 2015-16 to 2020 was a market cycle in which the high quality mega cap style worked. In the last 1 year, the value and let's say cyclical segment has worked fantastically well, and those who stuck to it have got the benefit. Imagine imagine a fund manager who has underperformed for 3 years because he stuck to value and cyclical, and right at the striking of the pandemic, moves towards high quality and mega
you
caps.
you lose out at both sides. So this is what this is what is also classically known as style drift.
Yes.
And one of the key things that you have to look for is that your manager doesn't change style. And I definitely agree. I think, though I'll also have to add, from what we see from investor behavior, investors actually find it very hard. So what happens is, I think, to a certain extent, and some of the data also shows that, is that there is some style drift in fund managers, but I think once it was identified, there were a lot of kind of risk management and other tools that were put into place at asset management firms. So now we don't see a lot of manager style drift. We still see a lot of investor style drift. So investor still chases. So your manager stays core, but the investor says, "Oh, small caps are working. Let me buy small caps. Large caps are working. Let me buy large caps." So and I mean, again, I think that'll take some time and that'll take some experience from the investors to kind of solve for. But it's a very important point, I think, when we think about what returns do investors get through their investment journey, because at the end of the day, that is what is the most important marker on whether the industry is doing well or bad.
Correct. And that's why these two things are important when you're investing in equity markets. Time in the market is more important than timing the market. And if, like you said, people look at the rearview mirror and keep driving, there is bound to be an accident. Don't look at past returns and probably look at what's in store for the future. And most important, I think, is what you mentioned, right? That managers have probably put in place risk measures to ensure that the style drift doesn't happen, at least at the asset manager level. That's, I think, learning from the 2007, 8, 9 crisis. Those who learned from the 2007, 8, 9 crisis have ensured that they do not drift the style. And also, obviously, it's also up to the fund manager to be able to take the pressure, because underperformance has its own stresses.
Oh yeah.
Which I think seasoned fund managers can take it. On our FlexiCap fund, if I have to just probably relate to it, there are two things which probably we are doing, which will again mitigate the risks which we are speaking of. One is we have a model-based approach, a very simple model-based approach to allocate large cap, mid cap, small cap. So it is taking away one element of decision making from the fund manager, which can potentially cause higher risk to the investor. And that model is simply based on the relative valuations and the representation of each of these market cap categories. Simple model, easy to replicate. When applied with discipline, we believe will aid investors in their journey in the large, mid, and small allocation. So it will not be a constant large, mid, and small allocation. It will change with valuations. And
perfect. I mean, simplicity is the best policy, and like you rightly said, simple model, intuitive model makes a lot of sense, and that is the most important part, which is that always comes after the end. Implement it with discipline, because that is what usually is the hardest to achieve, especially when either you are up 50% or down 50%. People make errors only when there is euphoria or there is total gloom. Normal periods, it's okay. It's not something that you're going to take a decision on. So that's very, 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 very valid points. One last question, Chintan, if you can answer for us. How do you invest yourself? What is your own personal investment philosophy?
Yeah, so much like any other human being, I also have my follies in terms of investment. Like I said, in March, I also got afraid. I did not increase my equity exposure in a big way.
Right.
But yeah, what I do obviously is that a counter-cyclical approach to investing, wherein pick up the sectors and stocks which have valuations which I understand. Buy only those things which I understand, and not buy those things which I don't understand. Typical blockchain technology I don't understand, so I wouldn't invest in that.
Fair enough.
I tried, but I couldn't understand, so I left it. Obviously, gold as an asset class has stood as a time-tested, source of value, and of course, my wife likes it as an investment for obvious reasons. So I keep adding on to it, and it's a balanced approach towards having the right balance of equity, debt, and gold. And I think I follow that with discipline. Over the course of last 16 years, I've learned one thing, that if you have a disciplined approach towards asset allocation, I think you probably end up being wealthy in the right manner, rather than losing your sleep all the time. And I think sleeping well is most important. The pandemic has
Definitely most important. Yeah.
pandemic has taught us.
Fantastic. Yeah, I 100% agree. Thanks, Chintan. Thank you so much. And I really appreciate that you were so honest about how you have invested and what you've learned in the past 16 years. Really a pleasure having you here. Thank you so much.
Thank you so much. It's always a pleasure.